The Economic and Monetary Union is an umbrella term for the group of policies aimed at converging the economies of all member states of the European Union at 3 stages. Both the 19 eurozone states and the 9 non-euro states are EMU members. A member state, however, needs to comply and be a part of the third EMU stage, before being able to adopt the euro currency. And as such, the third EMU stage has also become largely synonymous with the eurozone. All member states of the European Union, except Denmark and the United Kingdom, have committed themselves by treaty to join the third EMU stage. The Copenhagen criteria is the current set of conditions of entry for new states wanting to join the EU. It contains the requirements that need to be fulfilled and the time framework within which this must be done, in order for a country to join the monetary union. An important element of this is a participation for minimum 2 years in the European exchange rate mechanism, in which candidate currencies demonstrate economic convergence by maintaining limited deviation from their target rate against the euro. 19 member states of the European Union, including most recently Lithuania, have entered the third EMU stage, and have adopted the euro as their currency. Denmark participate in the exchange rate mechanism. Denmark and United Kingdom has received a special opt-out from the EU treaties, allowing for a permanent membership of ERM2, without being required to enter into the third EMU stage. In regards of the remaining non-euro member states, they are committed by treaty to enter the third stage upon the time of complying with all convergence criteria. Of which the last one, however, is something the member state can choose not to apply for, if they do not want to adopt the euro. The non-euro EU member states will continue to use their own local and historic currencies. History. First ideas of an economic and monetary union in Europe were raised well before establishing the European communities. For example, already in the League of Nations, Gustav Stresemann asked in 1929 for a European currency against the background of an increased economic division due to a number of new nation-states in Europe after World War I. A first attempt to create an economic and monetary union between the members of the European communities goes back to an initiative by the European Commission in 1969, which set out the need for greater coordination of economic policies and monetary cooperation, which was followed by the decision of the heads of state or government at their summit meeting in The Hague in 1969 to draw up a plan by stages with a view to creating an economic and monetary union by the end of the 1970s. On the basis of various previous proposals, an expert group chaired by Luxembourg Euro unregistered trademark S Prime Minister and Finance Minister, Pierre Werner, presented in October 1970 the first commonly agreed blueprint to create an economic and monetary union in 3 stages. The project experienced serious setbacks from the crises arising from the non-convertibility of the US dollar into gold in August 1971 and from rising oil prices in 1972. An attempt to limit the fluctuations of European currencies, using a snake in the tunnel, failed. The debate on EMU was fully relaunched at the Hanover Summit in June 1988, when an ad hoc committee of the central bank governors of the 12 member states, chaired by the President of the European Commission, Jacques Delors, was asked to propose a new timetable with clear, practical and realistic steps for creating an economic and monetary union. This way of working was derived from the Spork method. The Delors report of 1989 set out a plan to introduce the EMU in 3 stages, and it included the creation of institutions like the European System of Central Banks, which would become responsible for formulating and implementing monetary policy. The 3 stages for the implementation of the EMU were the following. Stage 1, July 1, 1990 to December 31, 1993 On July 1, 1990, exchange controls are abolished, thus capital movements are completely liberalized in the European Economic Community. The Treaty of Maastricht in 1992 establishes the completion of the EMU as a formal objective and sets a number of economic convergence criteria, concerning the inflation rate, public finances, interest rates and exchange rate stability. The treaty enters into force on 1 November 1993. Stage 2, January 1, 1994 to December 31, 1998 The European Monetary Institute is established as the forerunner of the European Central Bank, with the task of strengthening monetary cooperation between the member states and their national banks, as well as supervising ECU banknotes. On December 16, 1995, details such as the name of the new currency as well as the duration of the transition periods are decided. On June 17, 1997, the European Council decides at Amsterdam to adopt the Stability and Growth Pact, designed to ensure budgetary discipline after creation of the euro, and a new exchange rate mechanism is set up to provide stability above the euro and the national currencies of countries that haven't yet entered the eurozone. On May 3, 1998, at the European Council in Brussels, the 11 initial countries that will participate in the third stage from January 1, 1999 are selected. On June 1, 1998, the European Central Bank is created, and in December 31, 1998, the conversion rates between the 11 participating national currencies and the euro are established. Stage 3, January 1, 1999 and continuing from the start of 1999, the euro is now a real currency, and a single monetary policy is introduced under the authority of the ECB. A 3-year transition period begins before the introduction of actual euro notes and coins, but legally the national currencies have already ceased to exist. On January 1, 2001, Greece joins the third stage of the EMU. On January 1, 2002, the euro notes and coins are introduced. On January 1, 2007, Slovenia joins the third stage of the EMU. On January 1, 2008, Cyprus and Malta join the third stage of the EMU. On January 1, 2009, Slovakia joins the third stage of the EMU. On January 1, 2011, Estonia joins the third stage of the EMU. On January 1, 2014, Latvia joins the third stage of the EMU. On January 1, 2015, Lithuania joins the third stage of the EMU. Criticism: there have been debates as to whether the eurozone countries constitute an optimum currency area. There has also been a lot of doubt if all eurozone states really fulfilled a high degree of sustainable convergence as demanded by the Maastricht Treaty as condition to join the euro without getting into financial trouble later on. Monetary policy inflexibility equals. Since membership of the eurozone establishes a single monetary policy for the respective states, they can no longer use an isolated monetary policy, for example to increase their competitiveness at the cost of other eurozone members by printing money under value, or to print money to finance excessive government deficits or pay interest on unsustainable high government debt levels. As a consequence, if member states do not manage their economy in a way that they can show a fiscal discipline, they will sooner or later risk a sovereign debt crisis in their country without the possibility to print money as an easy way out. This is what happened to Greece, Ireland, Portugal, Cyprus, and Spain. Plans for a genuine economic and monetary union, being of the opinion that the pure austerity course was not able to solve the euro crisis, French President François Hollande reopened the debate about a reform of the architecture of the eurozone. The intensification of work on plans to complete the existing EMU in order to correct its economic errors and social upheavals soon introduced the keyword genuine EMU. At the beginning of 2012, a proposed correction of the defective Maastricht currency architecture comprising, introduction of a fiscal capacity of the EU, common debt management and a completely integrated banking union, appeared unlikely to happen. Additionally, there were a widespread fear that a process of strengthening the union's power to intervene in eurozone member states and to impose flexible labor markets and flexible wages, might constitute a serious threat to social Europe. First EMU reform plan in December 2012, at the height of the European sovereign debt crisis, which revealed a number of weaknesses in the architecture of the EMU, a report entitled Towards a Genuine Economic and Monetary Union was issued by the 4 presidents of the Council, European Commission, ECB and Eurogroup. The report outlined the following roadmap for implementing actions being required to ensure the stability and integrity of the EMU. Second EMU reform plan in June 2015, a follow-up report entitled Completing Europe's Economic and Monetary Union was issued by the 5 presidents of the Council, European Commission, ECB, Eurogroup and European Parliament. The report outlined the following roadmap for implementing further EMU deepening actions, being required to ensure a smooth functioning of the currency union and to allow the member states to be better prepared for adjusting to global challenges. Stage 1, the EMU should be made more resilient by building on existing instruments and making the best possible use of the existing treaties. In other words, deepening by doing. This first stage comprise implementation of the following 11 working points. Deepening the economic union by ensuring a new boost to convergence, jobs and growth across the entire eurozone. This shall be achieved by creation of a eurozone system of competitiveness authorities. Each eurozone state shall create an independent national body in charge of the tracking its competitiveness performance and policies for improving competitiveness. The proposed eurozone system of competitiveness authorities would bring together these national bodies in the Commission, which on an annual basis would coordinate the recommendation for actions being issued by the national competitiveness authorities. Strengthened implementation of the macroeconomic imbalance procedure. Its corrective arm is currently only triggered if excessive imbalances are identified while the state subsequently also fails to deliver a national reform program sufficiently addressing the found imbalances, and the reform implementation surveillance reports published for states with excessive imbalance but without EIP only work as a non-legal peer pressure instrument. In the future, the EIP should be triggered as soon as excessive imbalances are identified, so that the Commission more forcefully within this legal framework can require implementation of structural reforms, followed by a period of extended reform implementation surveillance in which continued incompliance can be sanctioned. The macroeconomic imbalance procedure should also better capture imbalances for the Eurozone as a whole, not just for each individual country, and also require implementation of reforms in countries accumulating large and sustained current account surpluses. Greater focus on employment and social performance in the European semester. There is no one-size-fits-all standard template to follow, meaning that no harmonized specific minimum standards are envisaged to be set up as compliance requirements in this field. But as the challenges often are similar across member states, their performance and progress on the following indicators could be monitored in the future as part of the annual European semester: getting more people of all ages into work, striking the right balance between flexible and secure labor contracts, avoiding the divide between labor market insiders with high protection and wages and labor market outsiders, shifting taxes away from labor, delivering tailored support for the unemployed to re-enter the labor market, improving education and lifelong learning, ensure that every citizen has access to an adequate education, ensure that an effective social protection system and social protection floor are in place to protect the most vulnerable in society. Implementation of major reforms to ensure pension and health systems can continue functioning in a socially just way while coping with the rising economic expenditure pressures stemming from the rapidly aging populations in Europe, in example by aligning the retirement age with life expectancy. Stronger coordination of economic policies within a revamped European semester. The country-specific recommendations which are already in place as part of the European semester, need to focus more on priority reforms, and shall be more concrete in regards of their expected outcome and timeframe for delivery. Periodic reporting on national reform implementation. Regular peer reviews or a comply or explain approach should be used more systematically to hold the member states accountable for the delivery of their national reform program commitments. The Eurogroup could also play a coordinating role in cross-examining performance, with increased focus on benchmarking and pursuing best practices within the macroeconomic imbalance procedure framework. The annual cycle of the European semester should be supplemented by a stronger multi-annual approach in line with the renewed convergence process. Completing and fully exploiting the single market by creating an energy union and digital market union. Complete construction of the banking union. This shall be achieved by setting up a bridge financing mechanism for the Single Resolution Fund. Building up SRF with sufficient funds is an ongoing process to be conducted through 8 years of annual contributions made by the financial sector, as regulated by the Bank Recovery and Resolution Directive. The bridge financing mechanism is envisaged to be made available as a supplementing instrument, in order to make SRF capable straight from the first day it becomes operational to conduct potential large-scale immediate transfers for resolution of financial institutions in critical need. The mechanism will only exist temporarily, until a certain level of funds have been collected by SRF. Implementing concrete steps towards the common backstop to the SRF. An ultimate common backstop should also be established to the SRF, for the purpose of handling rare severe crisis events featuring a total amount of resolution costs beyond the capacity of the funds held by SRF. This could be done through the issue of an ESM financial credit line to SRF, with any potential draws from this extra standby arrangement being conditioned on simultaneous implementation of extra ex post levies on the financial industry, to ensure full repayment of the drawn funds to ESM over a medium-term horizon. Agreeing on a common European deposit insurance scheme, a new common deposit insurance would be less vulnerable than the current national deposit guarantee schemes, towards eruption of local shocks. It would also carry less risk for needing injection of additional public money to service its payment of deposit guarantees in the event of severe crisis, as failing risks would be spread more widely across all member states while its private sector funds would be raised over a much larger pool of financial institutions. EDIS would, just like the national deposit guarantee schemes, be privately funded through ex-ante risk-based fees paid by all the participating banks in the member states, and be devised in a way that would prevent moral hazard. Establishment of a fully fledged EDIS will take time. A possible option would be to devise the EDIS as a reinsurance system at the European level for the national deposit guarantee schemes. Improving the effectiveness of the instrument for direct bank recapitalization in the European Stability Mechanism, the ESM instrument for direct bank recapitalization was launched in December 2014, but should soon be reviewed for the purpose of loosening its restrictive eligibility criteria. While there should be made no change to the current requirement for a prior resolution bail-in by private creditors and regulated SRF payment for resolution costs first to be conducted before the instrument becomes accessible. Launch a new capital markets union. The European Commission has published a green paper describing how they envisage to build a new capital markets union, and will publish a more concrete action plan for how to achieve it in September 2015. The CMU is envisaged to include all 28 EU members and to be fully built by 2019. Its construction will, a. improve access to financing for all businesses across Europe and investment projects, in particular startups, SMEs and long-term projects. b. increase and diversify the sources of funding from investors in the EU and all over the world, so that companies, in addition to the already available bank credit lending, also can tap capital markets through alternative funding sources that better suits them. c. make the capital markets work more effectively by connecting investors and those who need funding more efficiently, both within member states and cross-border. d. make the capital markets more shock resilient by pooling cross-border private risk sharing through a deepening integration of bond and equity markets, also protecting it better against the risk for systemic shocks in the national financial sector. The establishment of the CMU is envisaged at the same time to require a strengthening of the available tools to manage systemic risks of financial players prudently, and a strengthening of the supervisory framework for financial actors to ensure their solidity and that they have sufficient risk management structures in place. A harmonized taxation scheme for capital market activities could also play an important role in terms of providing a neutral treatment for different but comparable activities and investments across jurisdictions. A genuine CMU is envisaged also to require update of EU legislation in the following 4 areas: simplification of prospectus requirements, reviving the EU market for high-quality securitization, greater harmonization of accounting and auditing practices, addressing the most important bottlenecks preventing the integration of capital markets in areas like insolvency law, company law, property rights and the legal enforceability of cross-border claims. Reinforce the European Systemic Risk Board, so that it becomes capable of detecting risks to the financial sector as a whole. Launch a new advisory European Fiscal Board. This new independent advisory entity would coordinate and complement the work of the already established independent national fiscal advisory councils. The board would also provide a public and independent assessment, at European level, of how budgets a euro, and their execution a euro perform against the economic objectives and recommendations set out in the EU fiscal framework. Its issued opinions and advice should feed into the decisions taken by the Commission in the context of the European semester. Revamp the European semester by reorganizing it to follow two consecutive stages. The first stage shall be devoted to the eurozone as a whole, and the second stage then subsequently feature a discussion of country-specific issues. Strengthen parliamentary control as part of the European semester. This shall be achieved by plenary debate at the European Parliament, first on the annual growth survey and then on the country-specific recommendations. More systematic interactions between commissioners and national parliaments on country-specific recommendations and on national budgets. More systematic consultation by governments of national parliaments and social partners before submitting national reform and stability programs. Increase the level of cooperation between the European Parliament and national parliaments. Reinforce the steer of the Eurogroup, as the Eurogroup will step up its involvement and steering role in the revamped European semester. A reinforcement of its presidency and provided means at its disposal, may be required. Take steps towards a consolidated external representation of the Eurozone. The EU and the Eurozone are still not represented as one voice in the international financial institutions, which mean Europeans speak with a fragmented voice, leading to the EU punching below its political and economic weight. Although the building of consolidated external representation is desirable, it is envisaged to be a gradual process, with only the first steps to be taken in Stage 1. Integrate intergovernmental agreements into the framework of EU law. This includes the Treaty on Stability, Coordination and Governance, the relevant parts of the Euro Plus Pact, and the Intergovernmental Agreement on the Single Resolution Fund. Stage 2, the achievements of the first stage will be consolidated. On basis of consultation with an expert group, the European Commission will publish a white paper in spring 2017, which will conduct an assessment of progress made in Stage 1, and outline in more details the next steps and measures needed for completion of the EMU in Stage 2. This second stage is currently envisaged to comprise the Intergovernmental European Stability Mechanism should be moved into becoming part of the EU treaty law applying automatically for all Eurozone member states, in order to simplify and institutionalize its governance. More far-reaching measures could also be agreed to complete the EMU's economic and institutional architecture, for the purpose of making the convergence process more binding. Significant progress towards these new common convergence benchmark standards a euro, and a continued adherence to them once they are reached a euro would need to be verified by regular monitoring and would be among the conditions for each Eurozone member state to meet in order to become eligible for participation in a new fiscal capacity referred to as the economic shock absorption mechanism, which will be established for the Eurozone as a last element of this second stage. The fundamental idea behind the economic shock absorption mechanism is that its conditional shock-absorbing transfers shall be triggered long before there is a need for ESM to offer the country a conditional macroeconomic crisis support program, but that the mechanism at the same time never shall result in permanent annual transfers, or income equalizing transfers, between countries. A first building block of this economic shock absorption mechanism could perhaps be establishment of a permanent version of the European Fund for Strategic Investments, in which the tap by a country into the identified pool of financing sources and future strategic investment projects could be timed to occur upon the periodic eruption of downturns shocks in its economic business cycle. Another important precondition for the launch of the economic shock absorption mechanism is expected to be that the Eurozone first establish an increasing degree of common decision-making on national budgets, and an enhanced coordination of economic policies. Stage 3, reaching the final stage of a deep and genuine EMU, by also considering the prospects of potential EU treaty changes. All of the above three stages are envisaged to bring further progress on all four dimensions of the EMU, economic union, focusing on convergence, prosperity, and social cohesion. Financial Union, completing the banking union and constructing a capital markets union. Fiscal Union, ensuring sound and integrated fiscal policies. Political Union, enhancing democratic accountability, legitimacy and institutional strengthening of the EMU. References. Further reading, Simonazzi, A. and Vianello, F. 1998, A Euro OE Italy towards European Monetary Union. A Euro, in, B. H. Moss, J. Michie, The Single European Currency in National Perspective. A Community in Crisis. Macmillan, London, ISBN 978-03-33-79293-3. Hacker, J. Paragraph RN, On the Way to a Fiscal or a Stability Union? The Plans for a Genuine Economic and Monetary Union, FES, online at http library festiad 1040 PDF. External links, EMU, A Historical Documentation, The Euro, European Integration Process, 1969–1979 Crises and Revival, Economic and Monetary Union Cooperation Subject filed by the CVCE, Completing Europe's Economic and Monetary Union, 5 Presidents Report.